first tick on the index is very, very flat. 19,680 is what the Nifty is trending at.
It's absolutely unchanged on the Nifty and the sensex.
For the markets, there has been some recovery.
The candle is inside the previous candle. So it basically indicates exactly what it is, which is, the range tightening a little bit of indecision and not very much by way of activity. It's been an absolutely quiet kind of day on the Nifty. We spent the entire day within yesterday's range.
Hello and welcome to Markets Today, the show where we track about 6 hours of the day's trading action and 5 headlines. I'm Surabhi Upadhyay, and here are the headlines for the day. Sensex and the Nifty end with marginal losses after a range-bound session. Banks and mid-caps also end in the red. Tata Steel perks up after Moody's upgrades the company's rating to investment grade on the back of considerable deleveraging and on expectations of improved profitability, even as lower steel prices impact revenues. JP Morgan CEO Jamie Dimon says the optimism on India is completely justified. Estimates that the inclusion of Indian bonds in JP Morgan's emerging market index will enable additional foreign inflows of around $25 billion into India. That's a CNBC-TV18 exclusive. ITC Sanjeev Puri says the hotel's business demerger is on track with its 15-month timeline, adds that the business will be debt-free soon after the demerger is complete and significantly strengthen the group. Sees green shoots in rural demand. That's another exclusive. Eicher Motors gains on a buy rating from Jefferies. Varun Beverages rallies as the Bank of America Securities expects strong growth and profitability. Dixon Tech also surges on a positive outlook from DAM Capital. A downgrade from Kotak Institutional Equities drags Eicher Paints. Well, here's the lineup on what we have in store for you today. It's a packed show. In Market Opinion, we have Mixo Das, Asia Equity Strategist at JP Morgan. In Big Corporate Voices, we have Tata Steel's MD and CEO TV Narendran, Jamie Dimon, Chairman and CEO of JP Morgan Chase, and Sanjeev Puri, Chairman and Managing Director of ITC. Well, let's now talk markets. It was another quiet day on Dalal Street. The market traded in a narrow range to end the session absolutely flat. What we had was a range as narrow as just about 60 points, but it's not that bad if you consider how global markets were trading, because Asia was actually down between 1 and 1.5%. And by the time we came down to close, even European markets were lower by about 0.5%. So overall, that whole narrative and the concern around rising, surging US bond yields, that has kept global bulls in check. So against that backdrop, it's probably not such a bad performance. Let me quickly talk about the movers and shakers. Now, the problem for the bulls today was that neither banks nor IT, neither of these two big sectors fired up. I mean, bank stocks were lackluster throughout the session. There wasn't any big fall on the Bank Nifty or individual stocks, but they simply didn't contribute. Whether it was Kotak, IndusInd Bank, Axis Bank, most of those names were on the downside. Ditto for IT. Your biggies like Infosys, TCS or Tech Mahindra, they were down between 0.5% to about 1.5%. So these two sectors not firing. What did work for the bulls, however, was the two-wheeler space. It seems the festive buying that we have been seeing in the auto pack, that continued at least for two-wheelers. In addition, for Eicher, there was a positive Jefferies note that came in, and that really added more momentum to that stock. So 2.5%, 3%, depending on which one you're looking at. Very, very quiet session for mid-caps, and that was something that stood out. There was no great outperformance, so to speak, at the mid-cap index level. Advance decline ratio was absolutely neck-to-neck, 1:1 in terms of the advances and the declines. But as we told you in the headlines as well, it was very stock-specific, very company-specific action that played out in mid-caps. Varun Beverages and Dixon would be examples where, for instance, we got a bit of a pop on the stocks thanks to a positive brokerage commentary, and we'll tell you more about that as we go forward. On the flip side, we saw profit-taking come through in sugar, in PSU banks, and these are areas of the market that have rallied very, very hard. So there was profit-taking coming in, not too much, maybe just about 2 to 3%. But yes, there was some money coming off the table in some of the mid-cap pockets that have been running very hard. Going forward, really, it is all about those surging US yields, because by the time we closed, the US 10-year was still at 4.5%. So we need to watch for that, and the fact that the US equity market has sold off quite a bit. It's down about 4% in September so far, if you're looking at the broad market indices. And that continues to be a bit of a worrying factor for equities even here in India. So that was the overall narrative that played out in the market today. But let's get you more on in terms of market opinion. Mixo Das, Asia Equity Strategist at JP Morgan, says that the downside to global equities in the near term could spill over to the Indian market. He also added that there's no upside ceiling on Indian market valuations. The only issue is that investors are massively overweight on banks.
Is what's going to happen to U.S. equities, which really look quite fragile in the context of the next 2 to 3 months. Given the rise that we've seen in bond yields and the bond volatility has been picking up, that typically tends to spill over into equity volatility. We've seen some of that in the last 2 or 3 days. And this could easily go on for several weeks to months, and we could see some downside in a global equity framework. So if you look at a trend-adjusted forward PE, which is how we tend to look at market valuations, in India, it's about 21 to 22 times right now. And that's definitely on the higher end. It's about 1.5 standard deviations above its long-term average. There is no upside ceiling on the Indian equity market valuations at, say, 22 or 23 times. The only issue is that investors are already massively overweight the banks.
Okay, let's move on to the second headline now. Tata Steel gained 1% after credit rating agency Moody's upgraded its rating on the stock. It has assigned actually not on the stock, on the debt of Tata Steel. Moody's has assigned the firm a Baa3 rating from a Ba1 rating. It has also changed its outlook on the stock from stable to positive. Nigel D'Souza is here with more details. Nigel, tell us more.
Well, that's right. Moody's has gone ahead and upgraded Tata Steel to investment grade. That's Baa3 rating. And they've also upgraded the outlook to stable. Now, they've put down a few reasons out there. So let's run you through a few of that. They believe that the upgrade reflects the expectation of continued strength in credit due to Tata Steel's dominant position here in the Indian market. So that's one point. The other factor they're talking about is, yes, steel prices are under pressure. And because steel prices are lower, that's what could put pressure on the revenues. But they believe that profitability will continue to do well. And remember, bulk of the profitability comes in from the India business itself. And finally, they take note of Tata Steel's deleveraging strategy that they have been undertaking over the last few years. They expect that to continue, and they expect the leverage position to be pretty much under check. Put all these factors together, and Moody's goes ahead and upgrades their rating on the stock. Back to you.
All right, thank you for that, Nigel. Now, Tata Steel's CEO, TV Narendran, spoke for the very first time since the UK government's £500 million support package. He believes the new deal changes the company's position in a competitive sense. Take a look.
It's a bit of a mixed bag just now. In India, things look strong because the demand is strong across sectors. And Indian steel producers, even without exporting much, are fully utilized. The capacity is fully utilized selling in the domestic market. So I expect prices to continue to be a bit strong. Second thing which is helping prices or pushing up prices is the input costs are going up. Coal prices have gone up about $70 in the last few weeks. Iron ore is still quite strong. So a lot of input costs are going up, which is putting pressure on prices. On the other side, internationally, things are still a bit fragile because China has not yet come out strongly post-COVID. Europe is still a bit fragile. US is looking quite resilient. So let's see how international markets turn out to be. But I expect H2 to be better than H1.
The resolution that you have arrived at with the UK government, how does this help Tata Steel? What next? What are the next steps from here?
So I think it addresses the issue that we've been dealing with for a long time, which is the lack of competitiveness in our UK operation because of legacy issues. By choosing a new process route, which is leveraging the steel scrap which is available in the UK, we are basically changing the competitive position of Tata Steel in UK. And that will make sure that it's a sustainable business, not just from a CO2 point of view, but from a financial point of view. And I think the UK government is supportive because they see it as an important step to reduce the carbon footprint of industry in UK. And Tata Steel is a very important part of the industrial value chain in the UK.
So how would you see this financial support that is coming from the UK government? How will this play out?
I think it's something which is happening across Europe. If you look at European governments, they are supporting steel industries to make this transition because honestly, the cash flows of the industry in Europe don't support the transition to be undertaken by the industry by themselves. So whether it's Germany, Spain, and now UK, you see multiple countries helping the industry transition. So part of the funding is obviously from the company, part of the funding is from the government. And part of the funding in some sense comes from customers who are willing to pay more for green steel.
And finally, what are the growth drivers that you see for this year, for the remaining part of this fiscal?
So India, the growth is strong. I think steel consumption is currently growing at about 10% a year, which is very good, which is the way it should be. I mean, normally steel consumption in developing countries have to grow faster than the GDP growth rate. So I think India is seeing a period which is like that, and not surprising because of the fact that there's a lot of focus on infrastructure.
Okay, well, let's move on then to the third headline of the day. JP Morgan CEO Jamie Dimon says the optimism on India is completely justified. Estimates that the inclusion of Indian bonds in their EM index will enable additional inflows of around $25 billion into India. He cautions that the US should stop thinking of China as a 10-foot giant and negotiate better trade investments with India.
I remember 8 years ago or 9 years ago when it started, it was like 50 or 75 clients. Now it's 700 investors from around the world, 70 companies or 100 companies presenting. I think the optimism about India is actually completely justified.
Well, what do you believe is driving that optimism today?
Modi's been doing a very good job in things like Aadhaar, to get a bank accounts for 700,000 people, simplifying taxes, trying to open up more for foreign direct investment, the national infrastructure program. But just think of your universities here. So we're not the only bank here. There are lots of the banks with a lot of people, but so is Accenture, McKinsey, and obviously you have your local, Tata, et cetera. So those things are driving optimism. It's not just because of the complications with China. I think that's an opportunity. I think some of this optimism would have been there anyway.
Follow up on the inclusion into the bond index, and there's all kinds of estimates on what that could mean in terms of inflows into India. Anywhere between $25 to $40 billion is the estimate over the next year and a half as the inclusion works its way out. Typically, what's been the previous experience of a country being included in the bond index? What are the implications in the medium to long term?
Yeah, so our folks think it'll be about $25 billion. It has to be bought, so it gets bought over time. But I think it's a wonderful thing when you index like that, what it means about your capital markets, your rule of law, your transparency, your government financing. The indirect effect is more important. What you want is capital, foreign direct investment, both in plant and equities and things, innovative companies and stuff like that. So it's just one more very positive sign.
Speaking of signs, I want to understand from you what your key takeaways about China at this point in time. You were there in May, and you said that the outlook that you had on China was cautious when you talk about the risk rewards at this point in time. How do you feel about China today, and do you believe that we're done with the unraveling as far as the real estate sector is concerned, or we're far from it?
Yeah, well, I think the far more important, to me, this Ukraine war, oil, gas, food, migration, it's affecting all global relationships, very importantly, the one between America and China. I think America takes this very seriously. I'm not quite sure the rest of the world does. To have a European democratic nation invaded under the threat of nuclear blackmail, and I think there's been a good response. But it's going to affect all of our relationships until somehow the war is resolved. And India is going its own way. They've made their priorities quite clear about national security and what that means. We're still there, and obviously I'm an American patriot, so governments are going to set foreign policy, not J.P. Morgan. But I'm happy, and I think Americans should stop thinking that China is a 10-foot giant. Our GDP per person is 80,000, theirs is 15. We have all the food, water, and energy we need. We've got the unbelievable benefits of free enterprise and freedom. And they're going to have their own issues, and I'm not making fun of them. They're going to have their own issues about demographics and energy and climate, et cetera. I like the fact that the Americans are engaging with them now.
Well, we'll slip into a break on that note. We'll be back with the other headlines of the day in just a bit. Welcome back. Here with us on Markets Today. The fourth headline of the day, CNBC-TV18 exclusive. ITC Chairman and Managing Director Sanjeev Puri said that the hotels business will be debt-free after the demerger is complete and will be able to fund its expansion for the next 2-3 years. Speaking on demand, Puri said that the company has grown faster than the industry and he sees some green shoots in the rural sector as well.
Listen, this is the first time that we are speaking to you after the hotel demerger announcement. So let's understand where things currently are on track as far as the movement of shares is concerned, as far as the hotel business is concerned. And what's the outlook from here? Because you will continue to hold about 40%. Why did you feel it necessary to do so? And what's the plan now as far as investing in the hotels business is concerned from here on?
So first of all, yes, as far as the process is concerned, it's just started. So, I mean, nothing to say that, nothing much to say, it has just started. It's about a 15 months journey, and we believe it's well on track because we are well prepared for it. As far as the restructuring is concerned, I think, yeah, this 40% issue has actually generated a lot of media interest, though our shareholders were fairly complimentary in the AGM, and I had also occasion to hear the same, compliments from certain institutional investors, because this has been very well thought out. So that fundamentally we must recognize that whatever we do must position the business in a much stronger wicket than in what it was before. As far as we are concerned in terms of the trajectory, I think you've seen in the last few quarters that we've held on the growth rates quite well in the upper quartile, and rural also there are some certainly green shoots of pickup are there definitely.
Okay, let's move to the fifth headline today. Eicher Motors gained 2% and was one of the top nifty gainers. This after global brokerage firm Jefferies put out a buy rating on the stock. Jefferies believes that it's a good time to buy given alleviating competitive concerns. Sonia has more details on this. Sonia?
Absolutely, so Eicher Motors is the top nifty gainer, as you said. It's almost 4% higher. Now, Jefferies has a buy, but they have raised their target price to 4,150, which is a big upside to the current market price. Now, they say that there is, of course, rising competitive intensity, but because of the competition rising, the stock has underperformed the auto index. So, if you look at it, Eicher Motors is lagging the Nifty Auto Index by almost 24%. And despite fresh competition, channel checks suggest that the competition has not impacted the company just yet. So this is perhaps an opportune time to enter into the stock, according to Jefferies. They say it's a good time to buy given alleviating competitive concerns. There are also a lot of tailwinds that the sector is seeing, whether it's two-wheeler demand recovery, whether it's industry premiumization. Exports have picked up as well. And they expect the EBITDA of the company to rise 62% over the next 3 years and the EPS to rise 81% over the next 3 years. So that's perhaps one of the reasons why the stock is up about 4% or so.
Okay, all right. That was Sonia earlier there. Let's move on to some more brokerage opinion. Varun Beverages rallied over 4.5% after Bank of America Securities put out a buy rating on the stock and raised the target price as well. The brokerage firm expects growth and profitability to be sustained despite a volatile macro environment. Manglam has more details. Manglam.
Well, thanks for that. Varun Beverages indeed did well in today's trading session, and that's largely on account of BofA Securities' note, which was positive. They have a buy rating on the stock, and they've increased their target price to 1,030 odd as well. Now, the stock has seen a stupendous rally, over 40% gains in the last 6 months itself or so, and has been a multi-bagger in the past. But they believe that despite this run, there are strong tailwinds for the company and the stock itself. In fact, they do believe that the revenues of the company can compound at a rate of 19% over the next 3 years, and the net profit can compound at a rate of 23% itself, and which is much higher than all the other players in the consumer staples bit. What are the key drivers for Varun Beverages going ahead? First one, increased expansion, getting into newer geographies, and thirdly, newer product lines as well. Case in point, something like a Sting, which is the fastest growing product for them, has been doing extremely well over the last few quarters for the company. They believe that similar products going forward could do well for them as well, and that's where their positivity emanates on the stock from.
Okay, Manglam, just hang on. Now, Berger Paints slipped nearly 2% today. This was after Kotak Institutional Equities downgraded the stock to a sell. The brokerage firm apparently believes that the recent rise in crude oil prices can be a risk to margin expectations in this year. So just fill us in on this as well, Manglam.
Berger Paints was lower in today's trading session on account of a downgrade coming in from Kotak Securities. They have, a target price of close to around 500 odd rupees. They've unchanged that, but their rating has come down to sell. And the reason why they say that is because the stock has outperformed. Now, remember, the stock was down by 9% in yesterday's trading session as well. But if you account for that too, it has seen a reasonable 7 to 8% sort of gain in the last 3 months, which brings it very close in terms of valuation to Asian Paints, just about a 4% discount, which Kotak believes is unmerited despite their outperformance in terms of domestic volume growth as against Asian Paints over the last few quarters. Why do they say that? Well, one, because crude prices are rising, so that poses a risk to the margins. And everyone in the paint industry is eyeing what takes place in the fourth quarter of this fiscal, which is the entry of the large competitor coming in form of Grasim, to which Kotak believes that Berger is a little more vulnerable than Asian Paints, as a result of which they've downgraded the stock.
Okay, got that. Thanks very much, Manglam. Staying with brokerage views, Dixon Tech surged about 4% after DAM Capital put out a buy rating on the stock. The brokerage believes that Dixon's revenues could see a growth of 70% CAGR over the next 3 years. Surabhi Sutaria has more details on this. Surabhi, that's quite a lot of optimism.
That's right. So DAM Capital met with the management of Dixon Tech and they see two main growth triggers for the company going ahead. Strong traction in the mobile segment. Now, smartphone volumes for FY24 could be in the range of 35 million for the company, and they see that mobile segment revenue can see over a 70% growth over the next 3 years. Also, Dixon has participated in the IT hardware PLI scheme, and that could be the next big growth trigger according to them. Dixon is contributing 250 crores of capex, which could lead to a revenue potential of over 48,000 crores over the next 6 years, and they will be seeing large client additions in the laptop segment. So they say that Dixon is geared well with these growth catalysts, and they are valuing the company at 42 times FY25 PE with a buy rating and a 6,000 rupees target price.
All right, Surabhi, thank you very much for that. Let's move on to one more story. Strides Pharma, the company's board approved the demerger of the CDMO and the soft gelatin businesses into Stelis Biopharma yesterday. Arun Kumar, Managing Director and Group Chief Executive Officer of the company, says that the standalone debt of Stelis will come down to around 300 crore rupees after this transaction.
The specialties division CDMO has got three parts. One is the soft gelatins business from Strides. This has been unlocked at 17 times EV/EBITDA when Strides is trading sub 10 times EV/EBITDA. So that's automatically a significant uptick in the valuation. That goes to 100% of that goes to all shareholders of Strides. So Stelis, on a standalone basis, the debt is reduced from 1,400 and it will be sub 350 odd crores post the Syngene transaction.
And with that, it's a wrap on this edition of Markets Today. Many thanks for watching.